Cash Flow Code. And today my guest is Matt Ruttenberg. And Matt is a third-party administrator, means that he's a person who's in charge of retirement plans. And today, that's what we're going to talk about. We're going to talk about retirement plans and how you can use them to help you get to financial security, or what I call financial freedom. And more importantly, why you need a retirement plan, because your business ain't going to do it by itself. So let's bring on Matt. And we'll start the conversation. Hey, Matt, how are you today?
Good, Josh. How you doing? Thanks for having me on.
My pleasure. So, business owners often, I assume you talk to business owners on a regular basis, and they may come in and have a conversation with you, and they'll say, "What do I need you for? My business is my retirement plan." And I assume you've heard that before.
Oh yeah, probably several times a week. Several times a week, I'd say.
So when you hear it, what do you say?
I say, well, lack of diversification. It's almost like you're investing all your eggs in one basket, and you're investing in a micro stock, which is still larger than what most folks are running. Their businesses are still smaller, but it's like you're putting all your eggs in one micro stock, and you're betting on that. So not only is it good tax planning and so on and so forth, but you're also diversifying amongst larger companies if you're getting in the market and so on and so forth. So that's kind of my entry into the conversation, if you will.
Yeah, I have a different conversation because that never worked with me when I own my food service company, and it almost never
Yeah.
works with any of the people I work with. It essentially is I say, here's a problem. You think your business is your retirement plan? It's not. And then I give them an example. For here's a good example. So, let's say your business makes $500,000 a year, and you live on $200,000 a year. That looks like a pretty good delta, and you probably have lots of cash flow for that. So here's the problem with that. When it goes time to sell your business, you might get somewhere around $2 to $2.5 million for your business. If you get $2 million for your business, you don't get to keep $2 million. You lose at least 40% to taxes and fees. So now you're down to $1.6 million, and you get to spend 4% of that a year if you don't want to run out of it.
Percent rule. That's right.
So that gives you about $60,000 a year.
That's
So we got a little problem here.
there's a little bit of a gap.
Yeah. Well, the
I
interesting
like
thing
that.
whenever I do that with folks is they say, "Oh, what can I do to fix this problem?" And that's where
That's
guys
right.
like you come in because, if you take the same business, this business owner is living at $200,000 a year, making $500,000 a year. If they take 150,000 and stop plowing it back in their business and give it to you, or give it to any advisor for that matter who's going to run a retirement
Yeah,
plan, they can do that. So the challenge
absolutely.
is I have $150,000 a year I can save. I don't want to pay taxes on it. What can I do? Because I've told my 401k is only good for 25,000, and that's not going to get me there.
That's right. Yeah, yeah. I mean, breaching the 6 digit mark is absolutely possible. And if you have that extra revenue and the profit that you're able to sink into and diversify out, there's a couple different strategies, and the way cash balance plan is just one of those options. Or let's say you own multiple businesses, or you have you have a day job, quote unquote, and then you have a second job of your own business, and you're creating your own business. And can you the question is, can you, quote unquote, double dip your 401ks? And if so, how do you do it so where the IRS isn't hitting you up for controlled group conversations and audits and so on and so forth. So yeah, there's a couple different high level strategies that we talk about. Yeah.
So let's just say, let's take the second job off the table because most of the folks listening to this are full-time business owners, and many of them own construction companies, which is where we aim this podcast at. So if you're owner of a construction company and you have 15 people work for you, you're making $500,000 a year, which is really very possible. I mean, there are plenty of
Yeah.
companies doing that. you really don't have a saleable company. So what do you bring to them? I mean, what is a cash balance plan, and
Yeah,
how do you put a whole bunch of money in your pocket and not as much for your employees?
absolutely. Yeah, yeah. So the best way that I can explain a cash balance plan, and I use a theory, or not a theory, but a concept. It's an upside down, three-tiered wedding cake. Okay. So the bottom layer, the smallest layer now at this point, is your 401k. It's the 20. If you're under 50, it's 20,500. If you're over 50, it's 20. So that's the standard, like you mentioned before, that we all know and love, 20,500. The middle layer is your profit sharing that allows you to get up to your $61,000 per year, and that would be considered an employer contribution. The bottom layer is an employee. You're an employee of your own company. The middle layer is now you're getting into the employer contributions. And the top layer now, which is the biggest because it's upside down wedding cake, is the cash balance plan. And depending on that's age banded, depending on how old you are, and that can get you up well over, $300,000 even depending on how old you are. So that's the theory of explaining how it works. Now, there's a lot more that goes into the calculations. You bring actuaries into play to make sure, fairness is the rule of the IRS when you're talking about retirement plans. So how do you give it to yourself and not everybody else? There's different ways to calculate and categorize employees depending on how big of a company you are. The structure is different for every single company, right? And do you have highly compensated employees? Do you have your relatives, and you have your spouse, you have your kids who are also considered and looked at like an owner of the company? If you have highly compensated employees, which is over $135,000 per year, then they look at you like you're the owner. So how do we mold the plan to where you as the owner is getting the mass majority of these things? And that's the goal. That's how we build these and mold these plans, because we want the ownership to diversify and take advantage of the revenue that's coming to the business and all the time and sweat and tears that have gone into it. We want you to have the majority of that money. So we design that, and there's different ways to calculate it with different gateways. And the best way I can explain it is every layer has to be designed in a specific way to benefit the layer above it. So, for example, safe harbor 401ks. I'm sure you've talked about this before, Josh. Safe harbor is usually the bottom layer, especially if you have full-time
Matt,
employees, right?
let's assume our listeners have no idea what we're talking about. So please
Sure.
explain what a safe harbor
Take it
is.
back a step. Let me take it back a step. Sure. So a safe harbor. So let's talk about the bottom layer here. The safe harbor 401k is a pre-approved matching investing schedule that the IRS says, hey, business owner, if you choose one of these options, we'll let you basically save whatever you want up to the 20,500. If you don't use safe harbor, then it's a traditional 401k, right? And then there's rules, there's annual testing, and you're limited to how much you can actually put inside the 401k. Just one instance is 2% over the average. So if everyone's averaging 5% contributions of their own money into the plan, into their own bucket, then you as the owner are only allowed to put in 2% of the average. That's kind of a basic explanation. So the question is, which kind of safe harbor? And there's gateways and minimums that each level has. And more often than not, we're doing a 3% contribution to everybody. Then that gets you, that allows you to put more into the profit sharing. And then there's another gateway there that you don't want to really go above a certain percentage. Otherwise, you can't max out the cash balance plan. So really, it's how do we design every single layer specifically? And it's all based around how the makeup of your employee pool looks like.
Well, most business owners I know could care less about the ins and outs of how a retirement plan works. They want to
Yep.
know two things. How much can I put away, and how much do I have to put away for my employees for me to get that amount to put away for myself?
Yep.
Now, one of the things I've done, I mean, I want to ask you this. Have you ever had somebody put $300,000 into their cash balance plan?
Oh, absolutely. Yeah. Yeah.
Okay.
And their spouse.
I
And their spouse.
haven't, but I'm sure they exist. But for the typical, construction company owner who's making 250 a year and has 500,000 in profits, and I say to them, no rules. If you could save all you wanted into your retirement plan, what would that number be? I've yet to hear anybody get to 300,000. I've not even had anybody get to 200,000. Typically, in that case, it's about 150,000.
Yeah, which is still, we work with a lot of uh, independent contractor like physicians who jump around from one hospital to the next doing surgeries, and they're doing $2 million a year, and they don't have a lot of overhead, and it's just them and their spouse, and we're able to duplicate that amount that they're contributing. And again, it's age banded, right? So if you're in your 60s, the most beneficial and the best way to max this out is if you're a business owner and you're older than your employee pool, then you have a much higher chance of giving them substantially less and you being able to breach that 6 digit mark. And when you look at the numbers, everything in business is net, right? What's the net? And we always compare it to, okay, what are the actuary costs? How much is this going to actually cost to keep that actuary in play? And as long as you're in the black substantially, which more often than not, the cash balance plan ends up being in the black substantially, to where there 5 digit differences in tax savings.
Yes. So the thing that I find, well, with construction companies, you're almost always going to have a workforce that's 20 years younger than a 50-year-old owner
Right. Right.
on average. You might have one
Mhm.
person close to your age who's been with you for a long period of time who is now a superintendent or a supervisor. But people swinging hammers and nails and saws, they're not 50 years old.
Right.
They're
Right.
typically in their 30s, sometimes up to 40s, but not very much older than that. And if you're 55 years old, which is typical for a business owner, they just haven't saved any money. And all of a sudden they're
Right.
55 and they say, oh, gee, what am I going to do to get out of this thing?
And that is the most common conversation, I think. And we probably do about, you know, 50 to 60 plans a year. And the revenue and the income and the profit is different for every single one. And we sometimes we'll do them for 40-year-olds, and even just into the 30s, depending on how the makeup of the company is. But when you get to that big of a difference, the amount that you have to give to your employees is substantially less. We just built one, and we design it. Every single one is designed. Okay, how do we do this? What if you bring your spouse in, even though they're maybe not involved? What if we add them to the payroll? How does that make things? Are you able to keep more money in your pocket as the ownership team? And a lot more often than not, we're doing $1,000, $2,500 that needs to go to the employees, where then the owner's breaching the 6 digit mark, on top of the 20,500 or the 27,000 mark if you're over 50. So um, more often than not, the plan makes sense when we're designing it. If there's enough revenue to work with, we're able to plan and consult with the client and the financial advisor to where we'll come up with a plan, see if this makes sense for the business owner.
Well, Matt, a business owner walks in your office and you see they are seriously underfunded for retirement, or they tell you they're seriously underfunded for retirement. And you do an analysis and you show it to them. They say, gee, I would really love to do this. I can't afford it. What do you say then?
In regards to the fees, or in
No, not the
regards to the
fees. I can't afford the
contribution.
contribution. Can't
Yeah,
afford the
well,
contribution.
see that's a big, that's where the problem lies. You've built this company, and you have to, the goal here is to create a company, like you mentioned earlier, or maybe it was before, when we were chatting a little bit before, um, separating yourself as the business owner, and letting this machine work underneath you, and to where you're kind of, I'm going to call it an absentee owner, but to where you're more, you're less involved, and scaling the company because you have employees and you're able to work above the business. So getting to the point of where you have enough profit to be able to put something into, all this, whatever you're paying yourself as a W-2, that's step one. But then how much profit can you afford it? Cash flow. That is a conversation we have. You have to usually go into, okay, when is the best time to implement this thing? And you sometimes cash flow is the biggest barrier because you haven't planned out, 2 years ahead of time that you want to put 200, $300,000 in these things. So how do we plan that ahead? And the good thing with these kind of plans, in 2019, I'm sure you're aware, the Secure Act, passed, and that changed the deadlines for employer contributions. So employer contributions is not going to run through payroll, but you have up until the day you file, including extensions, to implement and contribute into a cash balance plan. So it's really, the cash flow plan is very, very important, because you can't just implement and throw 100 grand into these things right off the bat. More often than not, you have to plan ahead. And that has been extremely beneficial. Sometimes it doesn't work out if you don't have the cash flow. That's where the financial planning comes into play, and so on and so forth. But cash flow and making sure that you implement and find a good flow of when the money can come in, that's absolutely sometimes a barrier, but we just have to plan ahead on that. And sometimes it
Yeah.
takes 2 years to implement.
Well, it may, and the reason would be is you got to make your business better.
Absolutely.
I mean, people
100.
come to me and say, "Gee, I'd love to put away that much money. I can't afford it." And I say, "Well, you have one of two options. You can work till you're 80, or you can make your business better. What do you want to
Right.
do?"
100%. And just so everyone, you said most of your, the people listening are in the contracting and commercial space and all that. That's not uh, specific to this industry, right? Doctors, lawyers, any high income business. I don't care what. It's all relative. More often than not, there's folks doing a cash balance plan. It's to catch up. It's to catch
Yeah.
up and not have to worry about getting caught up and paying too many taxes. And if you do it right, and it's really, really good to have the CPA conversation with this too, and make sure everyone's on board, because um, they're not turnkey, find online kind of situations. They are custom built plans. And sometimes we go to the actuary, our actuary, and we run it 3 times before they sign off on it, to make sure that it is built properly and it's going to implement at the right time. Because you don't want to get into these things and all of a sudden say, I don't want to do this anymore. You got to make it the right time. And if it's not the right time for a cash balance plan, let's back off that top larger tier of the wedding cake, and let's get into, just look at how do we maximize the first 2 layers with profit sharing. And there's different ways to do that too. There's different ways to calculate profit sharing. A lot of times a lot of people think there's one way to do it, because the online payroll type companies are out there. There's one way to do it. There's a way to categorize and do things age based. And at the end of the day, if you're substantially older than your workforce, your team, you're going to benefit more in the plan than they will. If you're the youngest, then we have to do some little extra planning.
So, Matt, I'm a business. I mean, I own a construction company, and I say,
Hmm.
"Good, let's go ahead and do this." And we go merrily along for 2 years. I'm putting $150,000 a year away, and then year three comes in, and we have a major recession. My business goes to pieces, and I don't have excess cash to put into the plan. Is there a way for me to solve that?
Yeah. So, the IRS, traditionally and historically has always liked you to have a 3-year window for these cash balance plans. There's way you can pause plans. We've paused plans because there was just a terrible year. And then you go back into it once you get the revenue back into it too. But so a cash balance plan is a form of a defined benefit plan, right? So a defined benefit plan is is basically a pension. So for GM, the old school pensions that we don't really see around anymore, where they're defining the benefit. They're giving a promise on the back end of how much this number is going to be. And it's, since a cash balance plan is a form of a defined benefit plan, you need to have that actuary involved, because every single year you have to keep that promise up, right? You have to keep that promise up. If you fall behind, you have to put a little bit more in. If you're ahead of time, you're doing good. You have to keep up with a certain percentage that the actuary gives you. And there are ways to pause it, but at the same time, when you're done with this, you're not stuck to the actuary forever. You shut down the plan, and you roll it into your 401k, you're rolled into an IRA, or however, whatever the financial planner tells you that's best option for you. But these cash balance plans don't need to be a lifelong part of your business. It's just, how long can we get this implemented for to get the cash that you need out so you can start diversifying, like you said earlier. So there's a little bit more leeway than traditionally and historically has been explained. But yeah, you can pause a plan, but at the same time, if this is a one-off 1 year great year that you had, I probably wouldn't recommend doing a cash balance plan, because it's frowned upon. Let's put it that way.
It's not a good idea to do that. But
It's
if you're
not. It's
having,
not.
if you have consistently had good cash flow, and then you have 1 or 2 bad years, you can certainly find ways around that. And this is
Absolutely.
something which I think is really important for folks to realize. When you say cash balance plan, you might talk to their accountant, and the accountant will say, "Oh, you're stuck with that. You can't make a change."
Yeah.
And what that shows is the accountant doesn't really know what they're talking about, and they want to save you heartache, or they don't understand, which is what I found when I first heard about a 401k. Went to my accountant. I said, "Hey, I hear there's this thing called a 401k. Should you do it?" And he said to me, "It's not for you." 4 years later, he comes back to me and says, "You need to have a 401k." I say, "Yeah, but Lloyd, you told me 4 years ago I shouldn't do it." And
We
here's what
work very. Go ahead.
and here's what we learned. I learned that when a CPA doesn't understand what you're saying, they won't say, "I don't know," and look it up. They'll just say, "It's not for you."
Bingo. Bingo. Yeah. So yeah, that is also a common conversation that I have. We train CPA teams on the types of retirement plans that are available, because the default for a business owner is like a SEP or a simple IRA. That's the default to from the CPAs is going to put together. But that's it's good for some folks, but it's not going to get you the full potential. It's a good starting point, but more often than not, there is substantially better options for business owners. And like I said, net, yeah, yes, there's a cost. There's administration cost. There's sometimes an actuary for a cash balance. What is the net between the difference between having a simple IRA versus being able to do a 401k with the much higher contribution limits, and the calculations are much better than the other options too.
Well, often it's a choice between retiring in your 60s or retiring in your 80s, and which one do you prefer more?
Hmm.
And when you put it that way, people will say, hmm, that change sort of gets their attention more than diversification or all the other conversations I've heard financial advisors have with business owners over the years. So, Matt, unfortunately, we have ended our time. We're out of time. And I'm going to assume there's some folks listening to this who would love to get in contact with you. So, if they did, how would they go about doing that?
Yeah, absolutely. I won't give you my email address. I'll let you put that in the notes because it's too long. But our website is simply 401k.expert. That's one of our websites that you can go to, and we have some really good tools on there. If you need to, we have something called the evaluator, which will ask you some questions, and within just a few seconds will spit out kind of the top priorities and best options for you. And then we can consult with CPAs, financial planners, whoever you work with, and kind of come up with the best plan. A lot of explainer videos and quick guides that we have out there too, just to get the ball rolling. Because one thing I would probably urge is don't wait till the last minute when you're trying to look into these things. It takes time, and finding the cash flow and the best time to do it. And there's deadlines. Start looking even if you're a year or two out.
Cool. And I've got two things I'd like you to do. One is, you've
Yes.
heard me say this a whole bunch of times. Please go wherever you're listening to this podcast and give us an honest rating review. And while you're there, why don't you subscribe? We come out here every week on Monday at 6 a.m. and you get to hear great conversations with folks like Matt. And I'm sure you'll find some really good value in it, especially if you happen to own a business. And two is that I write a weekly newsletter. I've been doing it for, I don't know, for about 40 years, not weekly, but it's been weekly for about 16 or 17 years now. And we come out every Tuesday at 9 a.m. It's really easy to get. You just go to www.sustainablebusiness.co/newsletter. That's www.sustainablebusiness.co/newsletter. Put in your first name and your email address, and you're on the list. And you'll get an email every Tuesday morning. Or I keep thinking it's going to be every Tuesday morning. I'm going to skip one, but I haven't yet. So here we go. So this is Josh Patrick. We're with Matt Ruttenberg. You're at Cracking the Cash Flow Code. Thanks a lot for stopping by. I hope to see you back here.